Hey, what's up? Ching. Today we're just gonna run through some definitions. Actually, we're just gonna go through one definition. Today's definition is gonna be dollar cost averaging, aka DCA. I'm gonna just read this quick definition. Dollar cost averaging is a strategy, an approach to purchasing an investment in which the buyer spreads out their purchase so the total price paid is less affected by market timing. Now, there's a saying that it's not about the timing of the market, trying to get the lowest price that you possibly can. It's time in the market, the amount of time that you are actually invested in the stock market. And over a period of time, fingers crossed, most of the time the stock market gradually goes up. There's a whole bunch of fluctuations, ups and downs, dips, crevices, valleys. And it's not always about getting that bottom price. Sometimes it's just getting in, right? And in this particular strategy of dollar cost averaging, what an investor might do is invest their money over a period of time. Let's say, for instance, a person has about $2,000, $2,000 that they want to invest into the market. Now they can technically just say, all right, boom, 2,000 is what I want to put in. Here's the 2,000, to their broker, whichever broker that they choose. Here's the 2,000, invest that in one time, lump sum, and they walk away. Hopefully the money generates income. But it also can go the other way where that stock now starts going down, right? In this example, the stock price now starts going down. So that $2,000 that they invested in is now starting to decrease in value. And you don't have any more money to put in. With dollar cost averaging, that same investor might say, I have 2,000 that I want to play with. I'm going to put 1,000 in at this particular price. And if it goes down, I have so much faith in this particular company that I'm going to invest another $1,000 in if it goes down to a particular point. Now, by doing this, using this particular strategy, not only are you able to take advantage of the lower price, sort of like a sale, if it's a good company, take advantage of the lower price. But if you bought at 1,000 at a higher price, buying a little bit more at a lower price, now brings your average cost to an average price, a mean price. So let's just run through a quick example of that right now. Let's say a person bought shares of XYZ, 100 shares at $10. That's going to cost them $1,000. Remember, in this example, that person have about $2,000 to play with. Now, XYZ, the price starts to decrease, and it decreases down to about $7. Now they're able to buy a little bit more than 100 shares with that same average $1,000. Let's say they bought 140 shares at $7. That's going to come up to about $980. So the first investment, $100 at 100 shares, $10, cost them an average of $1,000. Second investment, the dollar cost averaging style of investing. Now they're able to buy 140 shares at $7 for a total of $980. And if we calculate that, at the end of the day, they're going to own 240 shares of this particular company at an average price of $8.25 for a total investment of $1,980, as opposed to just putting all that money in at $10 and watching your investment decrease all the way, losing value down to $7. Now they have an opportunity to, like I said, bring their average buy-in to a lower price. Now that could also go on the other side of the coin, because the stock price could go up. Now if the stock price goes up, that same individual, they bought 100 shares at the original buy-in of $10, $4,000, but in this case, the stock price starts to go up. Now, they can still go through the same process of doing dollar cost averaging, but if they only have $2,000 in total to play with, they're not going to be able to buy as many shares as they did originally, because the stock price went up. So they start off with 100 shares, $10 buying, that's the $1,000. Price goes up, the price of the stock goes up in value. Now, again, they only have $1,000 to play with, so they're only able to now buy, let's say the price of the stock goes up to $20, right? Sounds beautiful. Price goes up to $20. Now they're only able to buy 50 shares at the $20 price, which would also cost them $1,000. Remember, they only had $2,000 to play with, and they didn't want to lump sum the entire investment in. So we're going to do the dollar cost averaging. That same individual, because the price went up, would be the owner of 150 shares at an average buying price of $13.33 for the total cost of $2,000. So as you see, in the first example, that an investor was able to dollar cost average as the price went down, which also decreased their buying price. In the second example, the price of the stock increased in value, so they weren't able to buy as many shares that fell in line with their budget. So they was only able to get 50 shares for the $1,000, and their average buying price also went up. So dollar cost averaging can work in your favor. It can work against you. There's many strategies that you can use. This just happens to be one of the strategies that is very popular, especially in these times where there's a possibility of recession. The stock market is continually going down. People are fearful. People are concerned that maybe I shouldn't invest right now because you don't want to see your investment lose money. But for other people, they may be looking at that as an opportunity to get in, because maybe their cost basis was higher originally, and now they get an opportunity to buy some more a little bit lower as the market goes down, and hopefully brings their average buying price down a bit. So when it goes up, hopefully they're able to reap more profit, right? So that's the thought behind dollar cost averaging. This is not financial advice. Take some time, figure out what you want to invest in, figure out what different strategies are available for you that are best for you. But in a down market, which we seem to be going through right now, dollar cost averaging might be something that you may want to look into. It might be beneficial to you. All right? Peace out. Let's get this bread. It's time in the market. It's not always about timing the market. It's time in. Be a part of the game. Even if you want to bench, learn some things. Coach calls you when you know exactly what to do. You know all the plays. You feel me? Right now, this is the opportunity that we can use to just learn some of these definitions, learn some of these different strategies. So when the market makes a move, you're already in, you're already a part of the team, and now you get the opportunity to reap those benefits. All right? Cha-ching, let's get this money. Peace.